Well, thank you all for coming to my I guess webinar. And I'm broadcasting live from New York tonight because I'm attending a Wiley-Wilmot conference here for the evening. So the topic for today is really about backtesting, and that's really the fundamental sort of tool for quantitative trading. You can't have quantitative trading without backtesting, but on the other hand, as I would tell you, there are many nuances and pitfalls associated with backtesting that we need to be very careful with. For those of you who don't know me, my name is Ernie Chan. I am the principal at QTS Capital Management hedge fund that is run out of in Niagara Lake, actually. I have been a quant, and since 1998 or 97, actually, starting with Morgan Stanley, and then I was with a prop trading group at Credit Suisse and various hedge funds. After that, I have been trading and backtesting algorithmic strategies since then. And in 2009, I published a book called Quantitative Trading, which dealt extensively with the nuances of backtesting. Some of what I'm going to talk about tonight, you can also find it in the book as well. And actually, I'm going to publish a new book called Algorithmic Trading Strategies and Pitfalls. That's the tentative title, about mid-2013. And it will talk more about certain nuances in backtesting. It turns out that the longer I work in finance and trading, the more nuances I discover associated with backtesting different instruments, futures, forex, equities. They all have their little quirks that you really have to be careful of in order for your backtesting to reflect reality and to be predictive of future returns. So I will talk a lot more about that in the new book, and also about different kinds of strategies in that book. And needless to say, we don't trade in our fund any strategies that cannot be backtested. In any size anyway. We might trade in very small portion as a test, but we will not trade anything in size unless we can backtest it. Now, what is backtest? Oh, by the way, please feel free to type in your questions through the chat window as we go along, and I will from time to time answer those questions. So please feel free to fire away even while I was talking. So what is backtesting? In backtesting, we feed historical data instead of live data into a computerized trading program. That's all there is to it. And so what we get out is the historical performance of the program rather than covering the live performance of the program. It's a little bit different from simulation because the data you feed in are real historical data. They are not generated by some kind of simulation or Monte Carlo techniques. So they are reflecting the real market. But backtesting is as I said, backtesting is what distinguishes algorithmic trading from discretionary trading. Because with discretionary trading, you can't possibly backtest. You can't clone yourself and put yourself back in the historical period and see what you would do. But if it's an algorithmic trading strategy, certainly you can clone the program and feed in historical data to see what the program would do in those historical periods. So why is backtesting important? Well, obviously, if you are developing a strategy from scratch, you would want to know how the strategy performed in the past without risking real capital right now. But oftentimes, we don't actually develop a strategy from scratch because read about the strategy from a magazine or learn about it from a forum or some fellow trader. And sometimes this developer of the strategy would be kind enough to even let us know the performance of the strategy. So if that's the case, you might ask, why bother to backtest it? Because we know everything about the strategy. We know the performance, which is probably great as presented to you, and we know the trading rules. So why bother to backtest it? Why don't we just implement it or even live trade it right away? Well, the reason that even in those situations we want to backtest the strategy is that we want to be able to replicate every detail. No one can actually describe every detail of the strategy to you unless you replicate, you rewrite the strategy yourself. And details are what makes a strategy profitable or unprofitable. It's really what makes or breaks a strategy. A lot of people ask, why are we publishing strategies in a book or a magazine? Aren't you giving out the family jewels by publishing a strategy? But I keep telling people, telling you the family jewels because it is really the detail that counts. So by backtesting a strategy, you are replicating every detail to make sure that it is performing the way that what the developer of the strategy told you, so that you have, it's like a science. It's exactly like what we do in science. Just because one laboratory are able to publish a result doesn't mean that let's say a medical procedure that had did very well in one hospital doesn't mean that it worked unless some other scientist is able to replicate it. The same goes for trading. The other thing is that why we need to really backtest a strategy is that oftentimes the performance that was published is inflated. It's inflated because of various pitfalls, which I will describe later. And you want to make sure that you are not falling into the same trap. You want to make sure that you are not committing those same pitfalls. And therefore, you really have to do the backtesting yourself. You can't rely on other people's backtest. And finally, oftentimes you can improve the performance of a backtest by making small changes in the original strategy. And that is a very powerful technique, is that without writing your own backtest program, it is impossible for you to really improve it. Now, I just convinced you that the backtesting is important, but it does also involve a lot of work. It sometimes can be very tedious because there are so many prospective strategies. It's impossible to backtest them all. So the question is there a way, is there a shortcut? Can we, just by reading about a strategy, decide whether we want to go ahead and backtest it? Because frankly, there are so many magazines, so many academic journals, so many trading books, so many forums out there that it is impossible to backtest every strategy you come across. So is there a way to filter out some of the strategies that are obviously unrealistic? So in the next few minutes, I will go through a series of examples where I will give you an overview of some of these the pitfalls of backtesting and show you how to judge whether a strategy is worth backtesting at all. Now, here's the first example. Let's say you read about a strategy that has an annualized return of 30%, a Sharpe ratio of 0.7, and a maximum drawdown duration of 2 years, and a maximum drawdown of 15%. Well, for those who don't know what the maximum drawdown is, it's basically the return from the high watermark to the present time, and the maximum drawdown is the maximum of all drawdowns over the course of time up to the present time. Okay, so here's the reported performance. Now, would you want to backtest it? Let me see if you can, if there's a way for you to raise your hand in this setup to show if you can backtest it or not. In some presentation software, you are able to raise hand. Let me see if you can do that. Maybe not.
I have not seen that yet. I have to get into. We could just have people just type in yes, 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 or why, no, no, no.
Okay, yeah.
When you guys do that, we gotta know.
Okay, everybody say no. Is there anybody who will say yes? Okay. All right. Nobody say yes, and you guys are absolutely right. My answer is also no, and the reason is that well, very few trader, as opposed to investor, has the stomach for a strategy that has a drawdown duration of 2 years. We need to pay our bills, and we are not a long-term investor. We need to keep our cash flow positive, if not every month, then at least every year. So, that kind of strategy, definitely we don't even need to worry about it unless you are able to modify it to shorten the drawdown. Otherwise, you should just discard it. And also, there's another more fundamental problem with a strategy that has a low Sharpe ratio in the long drawdown duration, because that means that the strategy, the performance is not consistent. Just because it has a high return, that might just mean that it was the result of a fluke, maybe a result of overfitting the model with historical data. So that is indicating also, a technical way to say that is that the statistical significance of the backtest result is very low due to its low Sharpe ratio and long drawdown duration. So we would not bother to backtest this kind of strategy. Okay, so moving on, the second example is you read an article that describes a high-frequency E-mini strategy, and the backtest has an average return of 20% and a Sharpe ratio of 2, and the average holding period is 48 minutes. Okay, well, would you backtest it? The question here is now, well, it seems to fit our criteria for high Sharpe ratio, and it has a very good return. So, okay, it might be worth backtesting it, but the question is, do we have enough information as described to decide whether this is really a viable strategy? Well, the answer I have is maybe. But the one major piece of the puzzle that is missing is transaction cost. Oftentimes when people report their performance results in magazines or other books, they do not include transaction costs for various reasons. It may not be that they are deliberately deceptive, but perhaps because transaction costs might be different for different brokers or different ways of implementing strategy. So, it's often easier to present a strategy without transaction costs so that we get the baseline result. But the problem is, with a strategy that holds for only 48 minutes, transaction cost is the major determinant of the profit. So for strategy that holds for a short period, less than a day or even a day holding, or just that holds for several hours, transaction cost is paramount. So it's very easy to develop a strategy that looks very good on paper, but once you add the transaction cost, it would be completely a badly losing strategy. So in those cases, backtesting without transaction cost is almost worthless. You really need to incorporate it properly and estimating it properly in order to assess the viability of the strategy. So the moral of the story is be very skeptical of backtest result of intraday trading strategies when they do not incorporate transaction cost. Okay, and third example. We have a simple buy low, sell high strategy that asks you to pick 10 lowest price stocks in an index in the beginning of the year and hold them for a year. And the reported return is in 2001 is an astounding 388%. Now, what is the issue? What is the potential issue of this backtest? There is a technical term for that. Well, curve fitting it may be, but it seems to be simple enough. The trading rule is very simple. It doesn't look like it's curve fitted. Well, the drawdown, let's say, is it's not given. That is true, but we don't know if it's bad. But there is one problem with this strategy, one potential problem of this strategy that could make it completely unrealistic. And yes, Clay got that one. There's a potential survivorship bias in this thing, and I will explain to you what survivorship bias. Basically, we need to backtest, particularly for stock selection strategy. we need to make sure that we are backtesting strategy using the stocks that existed at the time, like 2001, and not the stocks that exist today. For instance, if you're only using today's stocks to backtest those that strategy, you would not have backtested Enron. You would not have backtested WorldCom. You would not have backtested Nortel. And because you have excluded those stocks that have become bankrupt, that have been delisted, you are really biasing your performance. You are skewing your backtest performance to the positive. And that is what we mean by survivorship bias. We are only testing a strategy on those stocks that survive until today. We are not testing a strategy on those stocks that actually have become disappeared throughout the years. And that can skew the strategy tremendously so that it gives you a very high return, but that return is unrealistic. And so, these are the big the three common problems. Well, let me give an overview first of all of the three biases that I'm going to talk about. The first is look-ahead bias. Those examples are just sort of illustrating some of these biases, but here let me give you a systematic overview. The first one is look-ahead bias, which is essentially using tomorrow prices to trade today. But this can only happen in backtest. It's basically a software bug. A lot of times when you're using this piece of software, you inadvertently have the algorithm using the next bar or future bars information to generate signal for the current bar. And that happens very often if you are using a procedural programming language such as Visual Basic or C++ or Java or MATLAB. It's less likely if you're using Excel to backtest. But that is a very common software bug, and that will definitely inflate backtest performance. The second bias is survivorship bias, which is what I said illustrated just now with the stock selection strategy. It's backtesting with the current stock universe and not with the historically accurate stock universe. Third bias, common bias, is the data-snooping bias, which is overfitting the model to historical data with a large number of parameters or trading rules. So, essentially, with enough parameters, you can fit your model to any set of data to trade perfectly. You will have no losing trade, right? But that doesn't mean that when you apply the model to unseen data or out of sample data, that the strategy or the model will still perform. So it's no point to generate perfect performance in the past or perfect perfect fit to the model to the data in the past. The point is that the model needs to predict accurately in the future, not that it fits the past accurately. And the problem with these biases is that all of them tend to inflate and inflate the backtest performance and therefore overestimate live return. That is very dangerous. So these biases are dangerous because we would rather that it would deflate the backtest performance. We should underestimate the live return. We will, so that we will, be very skeptical and trade small sizes. But when a backtest inflates the backtest performance, we tend to become overly confident and over-leverage a strategy, and that can easily lead to disaster. So they are very dangerous. So let me go over each bias in more detail. The look-ahead bias, like I said, is a common programming bug, and it happens to the best of us. I used to commit it practically every month. I've been doing that less frequently in the last few years, but that's just from experience and from paying more attention to my program. Example is using today's high or low prices as inputs to trigger a trading signal at the market open. Clearly, at the market open, you wouldn't know the days high and low. Or more subtly, sometimes we in pair trading, we need to know the hedge ratio between two stocks. How many shares of one versus how many of the other, one long and one short, in order to form a market neutral pair and to trade at pair trading. Well, to determine the hedge ratio, we need to fit it, let's say using linear regression, using some data. But if you are fitting it using the same set of data that you are running your trading strategy is, that you're generating signal on, you are committing look-ahead bias, because when actual trading, you wouldn't be able to determine that hedge ratio. So you have to use the hedge ratio using data that is lagged a certain period of time. So that's a more subtle kind of data look-ahead bias that people commit. And similarly, when you are optimizing parameters, you need to make sure that you will retest your model using out-of-sample data, because obviously if you are optimizing your parameter with the same set of data that you're backtesting, it will look very good. But again, in real trading, you wouldn't be able to optimize it unless you use data that occurred in the past. So all these are very common causes of the look-ahead bias. Easy to commit, but actually also easy to detect. One easy detection method is to see whether the backtest program can generate precisions on the last day or the last bar. If your backtest program actually requires future data to generate signals, then it wouldn't be able to generate a signal in the last bar. So that's one way to tell yourself that if it is unable to generate a signal in the last bar, it looks likely that your strategy has a look-ahead bias. And however, when you transition from a backtest program to a live trading program, it's also very easy to detect look-ahead bias, because at that point you will find that there's no way you can get to a certain piece of information from a live market data feed. The live market data feed wouldn't have the next bars high and low, for example, in order to generate this trading signal. So typically, it's pretty easy to detect. Now, it's easy to detect, but we don't want to have to keep committing it. So what's the best way to avoid it? To avoid introducing look-ahead bias in the first place? Well, that really depends on what kind of backtesting software you use. The best kind of backtesting software, in the sense that they would not allow you to commit look-ahead bias, are those that are designed specifically for trading. They are special purpose software that can be used both for backtesting and live trading. So with a turn of a button, the software can flip from a historical data feed to a live market data feed. So you're using exactly the same program to both backtest and to trade live. For that kind of trading software platform, there's no way there can be look-ahead bias, because a live trading program, like I said, cannot possibly have look-ahead bias. So if you are using one in the same program for backtesting, that backtesting program will also not have a look-ahead bias either. Examples would be Deltics, Progress Palmer, Quant House. These are more geared towards institutional traders, but for retail traders, obviously TradeStation is one example. And there's a new platform called FX1, which is sort of a super Excel-based software for forex traders that you can use for backtesting. But that's the mostly special purpose platform designed only for trading. But if you want to use Excel, it's not bad, because in Excel you are able to see that a row really depends on the past row. So you can see exactly visually what are the dependencies of the cell which contain the trading signal. You can make sure that it doesn't depend on the cell that are let's say forward to it or below that particular row. If you're ordering the data in a chronological manner, you want to make sure that the signal cell depends only on cells that are above it. So that's not a bad, although you still have to take a look, but it's easier to detect because it has a sort of what you see, what you get kind of appeal. But software that are most poor in this respect are, of course, the traditional languages like C++, Java, or even MATLAB, because they are essentially procedural language. You can feed in anything you want. There's no sense of time or rows number to it. So they are kind of dangerous, but you have to be really careful when you use these languages to backtest the strategy. Okay, so to talk more about the next bias is the survivorship bias. Like I said, you are backtesting a universe of stocks while ignoring or excluding those stocks that have gone bankrupt since the strategy was first applied in backtest. And going back to that buy low, sell high strategy, remember that we were picking 10 stocks with the lowest price from 100, let's see, is it 100? No, from 1,000 stock universe at the beginning of the year. And we are selling them at the end of the year. And, well, let's see what we would pick in 2001 if we have a survivorship-bias-free database. That is, if we have a good database that contains all the delisted stocks. So you would find Enron in this database, you would find WorldCom, you would find Nortel. Okay, let's see. So you will, here are the 10 stocks that the strategy would have picked. You would notice that the closing prices in the beginning of 2001 are all very low. These are penny stocks, and since we are selecting these stocks based on how cheap they are, in terms of their share price, no surprise that they are penny stocks. But what's more interesting is if you look at their closing price at the beginning of the next year, they are all but one of them have no closing price. I represent the price by NAN, meaning there are no closing prices. What happened to them? Well, it means that they have all disappeared 1 year later, except for MBM. Well, let's look at what are the last prices that they are traded. On the day just before the delisting. What are the prices? Supposing that we know they're going to be delisted tomorrow, let's sell the day before. At least we can salvage something. And so the fourth column shows their terminal prices, what I call the terminal prices, price just before their delisting. And no surprise, they are all quite low and much lower than their price in the beginning of the year. So it shouldn't come as a surprise to you that the portfolio return of this strategy is negative 42% according to this data set. But next we can look at our picks if our database does in fact have survivorship bias. That is to say, we have a bad database. This database only reflects the stocks that survive until today. It does not contain Nortel and WorldCom and so forth. Well, this is the table for that stock selection, and you can see that 9 out of 10 of those stocks are different. They are the strategy picked completely different stocks based on this new database, a bad database. And for this stock selection, you can find that their closing prices are generally higher. Good number of them have greater than $1 share prices in the beginning of 2001. And if we look at the 1 year later, we see that their prices are even higher. Big contrast from before where their price dropped or maybe they don't even exist. But here, 1 year later, they all are very high. And the fact that their price exists are no surprise because we select them based on the fact that they survive until today. So of course they survive 1 year after the beginning of the strategy. But what is a little bit maybe surprising is that their price is actually higher 1 year later. So, and if you calculate the total portfolio return of that strategy, it was the astounding 388%. So you can see that the return goes from negative to very, very positive just by switching from a database without survivorship bias to one that has survivorship bias, and therefore we are getting a highly unrealistic estimate of that of our performance of this strategy. But the 388% is of course unrealistic, and the negative at whatever 40 or 60% would be actually what this strategy achieved in 2001. The strategy, Nick asked whether this strategy applies, this bias applies to options or futures. It certainly applies to options because options are tied to stocks. So when you backtest option strategy, you want to make sure that if it's a stock option strategy, you should backtest on those options that disappeared, on those stocks that disappeared. it doesn't apply as much to futures because unless your strategy work or is supposed to apply to every future, then in that case, some future may have stopped trading, and you need to figure out how your strategy perform on those futures too. But generally, it's not a big problem. Typically, when we trade a future strategy, we don't apply to every single future out there. We only select a few, like the prominent liquid ones. So that's not as much of a problem. And okay, so what is the cure now that we know survivorship bias can be so damaging? Well, one way to cure it, of course, is to buy good quality data that does not have this bias. There are now a lot of reasonably priced data set that has, that give you all the listed stocks. For example, keybot.com, csidata.com. These are all just cost a few $100 for a few years of U.S. equity data. For tech data, if you want, high frequency data, techdata.com will also sell you those that does not have that does not have survivorship bias. Now, if you don't want to pay extra for those good data, you can restrict yourself to only recent years. Just for example, no more than 3 years of backtesting. That way, the survivorship bias does not affect the performance that much, because obviously the longer the data set, the more severe the survivorship bias, because more stocks have the chance of disappearing if you have a 10 years data set. But if you only have a 3 years data set, not that many stocks will disappear in that short period of time. And then finally, you can collect your own data day by day for future testing. If you capture all the data every day, take a snapshot of it, then obviously you will have a survivorship bias-free database as you go along. So after 1 year, you would have a historically accurate data set for yourself to backtest. Well, data snooping bias, changing topic, we're now going on to the third bias I talk about, is the data snooping bias. Essentially, it means that you have too many parameters in the model, or the model have too many trading rules. That the model is more complex than the data. That's a very bad sign. In that case, you are curve fitting. Your model is picking up noise and non-recurring patterns, and that kind of model typically will give you great backtest performance, but it has no predictive power. So, like I emphasize, that complexity can come from from having too many parameters or too many trading rules. Either one will basically introduce this bias. And the cure is, one way is to minimize the number of parameters and minimize the number of trading rules. Well, that's usually easier said than done, but it can be done if you build your model based on well-known, well-researched financial or economic principles of phenomena. For example, if you're pair trading, you can use a physical test called for integration. If you are momentum trading, you might want to look at this post-earnings announcement drift strategy. These are strategies that has a well-founded economic principles, and so if you see a profit opportunity, it is less likely to be due to curve fitting, more likely to persist into the future. So the flip side of it is try not to use a data mining or data-driven approach. Basically following 100 technical indicators on the data and see which ones stick. That is the pure data-driven approach, and that's very prone to data-driven bias. Nick asked, what was it for momentum trading? Oh, one way to ensure that the momentum that you see is real is that it's triggered by event. So when you see a momentum, we might want to ask, why is there momentum? Is it really just a fluke that we get momentum, or is it really based on some real economic driver? And if a stock has just announced if the stock has just announced earnings, that would be a good reason for the momentum, and so you can be more confident that the momentum you see are real and it's not a result of curve fit. So now I have a rule of thumb to judge how many parameters is too many. I basically want to make sure that I have the same number of parameters as I have the number of years in my historical data set. If I have 5 years of data, maybe I can tolerate 5 parameters. But of course, if you have high frequency data, that is fine. If you have high frequency data, you can count the number of bars rather than the number of days. And finally, to detect whether you have look-ahead data snooping bias, you should always run your model on an out-of-sample testing. After you've done with building a model, test it on data that you have never seen before, or run your model in a paper trading mode, walk-forward testing mode to see whether it holds up. If it works well in out-of-sample data, or during a walk-forward test, or a paper trading situation, then you can be more confident that your model doesn't have data snooping bias. Another way to do it is, if you have parameters and you want to optimize them, make sure that you're using a moving, backward-looking window to optimize the parameter, and not, backtesting and not optimizing it using the entire data set. So that's one way of minimizing the effect of optimizing. I mean, this problem is actually both a data snooping bias as well as the look-ahead bias. You should never optimize your model using the entire data set, because you would be introducing a look-ahead bias as well. Well, this ultimate way to prevent look-ahead bias is basically to have no parameter at all, and there are ways to do it, but you can probably read my blog to get some sense of what a parameter string model is. It has no parameters, and there are ways to create such a model. So that's pretty much. I think I've taken a lot of your time. Pretty much close. I should just wrap up this webinar. The conclusion is that there are many ways where backtests can go wrong, and all those ways tend to inflate the future expected performance. So they are very dangerous because it leads to overconfidence and over-leverage. And to avoid these pitfalls, pick a good backtesting platform that prevents look-ahead bias. Pick a good database that does not have survivorship bias, and choose a simple model that does not have data snooping bias. So thank you, and do keep in touch. You can email me or comment on my blog. And like I said, I do have a new book coming out, and I also run workshops in various places, as well as an online learning course that you take. So thanks again, everyone. And there is a few questions before I end. Let me see what is the Matt has a question. Matt asks if there are recommendations for good places to read about trading rules and strategy. Yes, certainly there are many academic journals. Well, my blog is a good place. My books are not a good place, but there are many other people who publish books and blogs about strategies, and certainly academic journals is one. Journal of Asset Management is one, Journal of Finance is another, Quantitative Finance is another. There are just so many academic journals, so you can really spend your whole day reading them if you have the desire to do that. I myself only read those articles that other people recommend to me, because I really don't have time to go through all of them. So take your pick on what journal to read. Yes, Matt, exactly. I agree with you. There are lots of junk articles, and usually you can filter them out just by reading the abstract. So as you become more experienced in backtesting, you know that you don't need to read the articles to know that they are junk. So just read the abstract. Sandra asked a question: when choosing the parameters for backtesting, do you ever try to test each one independently, or is that impossible? I don't think it's possible to test independently. It is possible to optimize them independently in a way so that you can fix all the n-1 parameter, but just optimize the n parameter. That is possible, but I don't think that you can choose them independently. I actually can't imagine how you can do that. Clay has a question. In my trading, do you tend to use daily return or shorter bars? Well, I try everything. If I have ideas for strategy that are daily returns, I will backtest them. If I have strategies that if I have ideas for high frequency, of course I will use shorter bars. So my objective is to move towards higher and higher frequency strategy. So certainly I would be more happy if my strategy holds a shorter period of time. I mean, HFT is a very generic term, but you can certainly test strategy that hold for just a few seconds. But yes, I mean, generally the shorter the holding period, the more investment in technical infrastructure you need to make. To perform backtest, there's a quick and dirty way to perform stress test. One quick way is to look for the worst days in financial history. Look at 5 or 6 days of the worst days. Black Monday, the Lehman Brothers collapse, maybe the flash crash, and the summer of quant fund meltdown in 2007, the U.S. federal debt downgrade the week following that, the Greek default sort of crisis. Look for those months or days and test your models on those days. So in Black Monday we had a drop of the S&P of about over 20%. So can your model at that with your target leverage withstand a Black Monday? That's the question you have to ask. That's a pretty easy way to perform back stress test. I seldom use Monte Carlo simulation to stress test it, although that's another way that many serious quants would do. But quick and dirty back stress test is just finding out those historically turbulent days. My next workshop in London, well, you can go to epchan.com and go to my link. So let me see if I can point you to that workshop. So if you go to my website, go to my workshops, and if you click on, for example, I have a new workshop, by the way, is on momentum strategies. So let's say you click on that, you'll find that it's April. So the week of April 10th, I'm giving all 3 workshops during that week in London. So you can take your pick on what workshop you want to attend. In Singapore, I teach a Master of Finance class, so they only run that class once a year, and typically it's in September. So you would have to wait until September. And oh, by the way, that class is not restricted to the students of the university, so anybody can take it. So let me clarify. So if you do want to travel to Singapore, by all means, you can take it. It's offered by the Nanyang Technological University. And like I said, there's some chance that the SUNY Buffalo will be offering a Master of Finance class that I'll be teaching as well. I would post that on my blog or my website when that is finalized. Let's see if there's any more question. Richard has a question about, I have a trading strategy. Can you state the criteria that would determine whether it's worth trading? Well, I don't know that there's a complete criteria. Like I said, you make sure that you avoid all the pitfalls that I have mentioned, and make sure that it has a good, decent Sharpe ratio. Make sure that it has not a very long drawdown duration, and don't have a very steep drawdown. And if it has a Sharpe ratio of greater than 1 and a and a drawline duration of just a few months, then chances are it's good. But you have to make sure that it doesn't commit any of the pitfalls. And the pitfalls that I've described in this webinar are by no means exhaustive. There are many others. And in my new book, I have enumerated many more, and it's they're just very specific to each market, each type of strategy. So it's really a long list. So I can't really give you a complete list right now because it's really long and tedious, the consideration. Okay, Bob has one question, so let's see. Let me take this one last question from Bob. And are you aware of any strategies that depend on when bank holidays occur? Yes, I have heard of these strategies. These are seasonal strategies that take advantage of certain rebalancing activities just before holiday. And I myself have not personally traded it, but I'm sure you might be able to find research about that in either academic journals or trading magazines.
Any other questions at all for Ernie? Not sure. Ernie, thank you very much for doing that. That was awesome.
Oh, okay. Thank you all for spending your precious evening with me, and good luck trading.
Yeah, thanks again. Looks like you're getting a bunch of thank yous in the chat mode there.
Okay, thank you all, and have a good evening. There's one last question. Blog that I recommend. Well, I sometimes post them on my blog, referencing links to other blogs and to other books. So, just I think basically check out my blogs for any recommendations to other blogs.
Wow, that was
all
really
right,
good.
Thank you all.
All right.
Have a good evening.
Thanks a lot. Thanks a lot for coming out. We'll have another series of webinars come January. A guy from Fix8, the author of Fix8, is going to be helping out my HFT platform. Other than that, have a good night. Thanks again,
Okay.
Brian. Thanks again, Ernie. Talk to you guys later. Bye.